Wandering RV is evaluating a capital budgeting project that is expected to generate $36,950 per year during its 6-year life. If its required rate of return is 10%, what is the value of the project to Wandering RV? To solve this problem using a financial calculator, for N you would enter 6, which represents the number of years and the number of payments for this project. IY would be 10 for the 10% required rate of return. You would have payments of $36,950, and there is no future value. After entering this into the calculator, you press the compute button, then present value. This would then give you a value of the project to Wandering RV. Of $160,926.88. Zebra Fashions is evaluating a capital budgeting project that should generate $104,400 per year for 4 years. Question A. If its required rate of return is 16%, what is the value of the project to Zebra? To solve this problem using a financial calculator, you would input 4 for N, which represents the number of years or payments. Enter 16 for IY, which represents the required rate of return for the firm. You'd have payments of $104,400, and there is no future value. So after putting that information in, you'd press the compute, then present value button, and this would give you a value of the project to Zebra Fashions of $292,130.06. Question B. If Leopard Fashions evaluates the same project, but its required rate of return is 12%, what will it determine the value of the project to be? To solve this problem using a financial calculator, you go through the same steps as you did in Part A, the only difference being that IY is now 12 for the 12% required interest required by Leopard Fashions. Once all the information is again entered into the calculator, you'd press the compute button, then present value. This would result in a value of the project to Leopard Fashions of $317,099.27. The same project has a different value to the two companies because the companies have a different required rates of return. The project has a lower value to Zebra Fashions because they require a higher rate of return, and the project has a higher value to Leopard Fashions because they require a lower rate of return. Conventional Corporation is evaluating a capital budgeting project that will generate $600,000 per year for the next 10 years. The project costs $3.6 million, and Conventional's required rate of return is 11%. Should the project be purchased? To solve this problem, you'd use the cash flow function of your financial calculator. You would input under CF0 negative 3.6 million. This is what Conventional Corporation paid for the project. You'd press enter, arrow down. C01 would be 600,000. These are the payments that you receive each year for the project. Again, enter, arrow down. And under F01, you would enter 10. This is the number of years or payments that you'll receive the 600,000. You'd then press enter. You'd select the NPV button, input 11 for the I, that is the 11% required rate of return, and then arrow down and press compute. This results in an NPV for the project of negative $66,460.79. Since this NPV amount is negative, this project would not be a good purchase. The CFO of Harebrained Stylus is evaluating a project that costs $42,000. The project will generate $11,000 each of the next 5 years. If Harebrained's required rate of return is 9%, should the project be purchased? To solve this problem, you'd use the cash flow function of your financial calculator. Under that function, for CF0, you would enter negative 42,000, which represents the cost of the project. Enter, arrow down. C01 is 11,000. It's the amount the project will generate each year. Enter, arrow down again. For F01, you'd enter 5. This is the number of years or payments that you'll receive the $11,000. Then press enter and select the NPV button, and then you would enter 9 for I, representing the required rate of return. Press enter, arrow down, and then press the compute button. This will result in an NPV for the project of 786.16, and because this NP value is positive, this project would be a good purchase. What is the internal rate of return of a project that costs $20,070 if it's expected to generate $8,500 per year for 3 years? The internal rate of return represents the discount rate that forces the present value of a project's expected cash flows to equal its initial costs. The required rate of return is not needed to compute this number. To solve this problem, you would again use the cash flow function of your financial calculator. Under CF0, you would enter negative $20,070. This is the cost of the project. Enter, arrow down. C01 would be $8,500. This is the payment amount that you receive every year. Enter, arrow down. For F01, you would enter 3. This is the number of years or number of payments that you will receive the $8,500. You press enter, then select the IRR button, then press the compute button. This results in an IRR for the project of 12.994 or 13%.